Welcome on board Cameron Brandt and figure out, which way flows actually are moving. Cameron, hi, evening to you and morning for us, but good to have you on the show. Just wanted to understand, there's a lot of concern in India about the relentless FII sell-off that one is seeing. And, this is not a new phenomena. All through last year as well, FII money clearly evaded us. Where's that money moving in within emerging markets? Because the clear suspect is that it's moving to China purely because of cheap valuations.
I actually think it's moving out of the emerging markets universe. In mutual fund and ETF terms, India is still doing very well. Dedicated India funds remain, at the moment, along with Taiwan, the stars in terms of attracting fresh money. But overall sentiment towards emerging markets is pretty fragile at the moment. You're in the midst of an election. Potentially significant elections are coming up in Mexico and South Africa, which are important waypoints in the emerging markets universe. And the general mood, certainly here in the US, is I think, a little sort of fragile and jumpy. We've seen retail investors coming back into the market, which, we could have a lengthy debate on the wisdom of crowds and whether institutional investors are right to be as skeptical of retail involvement. But we are seeing more interest all of a sudden in meme stocks. So it's definitely sort of a slightly confused, messy atmosphere at the moment. And circling back to your question, I think people are reluctant to engage with most emerging markets, though direct exposure to India remains popular. So the FII selling you're seeing is not coming out of the fund industry.
Why is money moving out of emerging markets? It is not that yields have gone up or Fed is not going to cut rates. The premise of money moves out of emerging market happens when Fed is on a relentless pursuit to kill inflation and when they're committed to take rates higher. That is not the underlying cause.
I think at least, in the very short run, it's partly that there is an attractive developed alternative at the moment, in that there's a good chance that when we get through the June run of central bank meetings, the Bank of England and the European Central Bank will have joined Switzerland and Sweden's central banks in starting a rate cut cycle. And that sort of really focused some positive attention on Europe. Stocks there, well, they were undervalued. They've rallied in a number of the bigger markets. But I think certainly people with cash to allocate are thinking, rather than dip my toes in the emerging markets world, there's going to be some opportunities in Europe in the next few months. And I'm more comfortable in developed markets. So I think that's part of the reason. I think South Africa's election, well, things seldom turn out in the worst case scenario. There's a real fear that the African National Congress will lose its majority and end up forming some kind of union with much more militant parties. And China remains cheap. It may be, but cheap it is for a reason. There's a lot of unresolved issues surrounding China and its trade relations, both with us and with Europe. China, though you can definitely make a strong case for it based on valuations and leadership in some key industries, is just not that attractive.
Okay. So Cameron, what to your mind could be the turning point where the reverse happens, when you could say that, okay, the trend is that money is moving out of developed markets and moving into emerging markets? What could be that trigger point which would reverse the current setup?
If you like this video, then like, share and subscribe to ET Now.